So now let's take a look at our cash disbursements. So again, remember that each pound of material costs us 40 cents. And we're saying that we're going to pay for one half of the material the month it was purchased. The other half will be paid in the following month. At the end of the first quarter, we owe $12,000. That amount will be paid in the month of April. Okay? So let's take a look at what's known as our cash disbursement budget, and I'll go through it. So we're paying the $12,000 that was owed at the end of the first quarter. In the month of April, the total cost for our purchases would be $56,000. This is based upon the information shown in our material budget we just went through. We're going to pay half of that in the month of April, the other half in the month of May. For our May purchases, they total $88,600. We're going to pay half of that in the month of May and the other half in the month of June. Our June purchases total $56,800. We're going to pay half of that in the month of June. The other half will be paid in the month of July. The other half, $20,400, will be the accounts payable at the end of June, and that amount will be shown on the budget for the third quarter. We're focused now on the budget for the second quarter. So our total cash disbursements for the second quarter would total $185,000. That's to pay for the payable that was out there at the end of March. That's paying for the material for the month of April, paying for the material for the month of May, and we're paying one half of the material cost for the month of June. So our total disbursement for the month for the second quarter would equal $185,000. Next up, our direct labor budget. All right. Now, we understand that in order to produce those units, we need material, right? But we also got to have employees. We also need labor costs. So this says each unit of product requires 0.05 hours, 3 minutes of direct labor. Again, each unit requires 0.05 hours or 3 minutes of direct labor. The labor can be unskilled because the production process is relatively simple. But keep it simple. So we're saying that each unit requires only 0.05 hours, which is 3 minutes, and the rate of pay is going to be $10 per hour. Now, I know what you're saying, that we're fighting for an average of $15 as the minimum rate of pay. I understand, but we haven't got there yet, right? So as of right now, we're only paying these employees $10 per hour. I'm sorry. So let's take a look at our production budget. This is showing how many units we plan to produce each month in the second quarter. Remember, the actual amount of time is 0.05 hours to make one unit. So this is showing the amount of labor hours required each month to produce these units. Hold on one second, I'll plug in my computer. Trying to cut me out of my video, but I'm back. All right. So this is showing the labor hours required to make the units needed for each month. And the hourly rate of pay is going to be $10 per hour. So now here you have our direct labor cost. So the total direct labor cost for the second quarter is $50,500. There's a total of 5,050 hours of labor required at a cost of $10 per hour. Total direct labor cost for the second quarter equals $50,500. Okay? So when you think about your production costs, you have those three components, right? Direct material, we covered that. Direct labor, we covered that. What's next? Yes, you got it. Manufacturing overhead is going to be next. Okay? So let's look to see how we're going to assign overhead costs for this company. We're going to assign overhead costs based upon direct labor hours. Again, we're going to assign overhead costs predicated upon direct labor hours. The variable overhead rate is $20 per direct labor hour. So we have a predetermined overhead rate, and it says the variable overhead rate is $20 per direct labor hours. So we're going to assign overhead costs based upon direct labor hours at a rate of $20 per direct labor hour. Now, the fixed overhead cost is $50,000 per month, which includes $20,000 of non-cash costs, which is called depreciation. So just a little background, depreciation is an expense, but it's a non-cash expense because we do not spend money when you're recognizing what's known as depreciation. So we do talk about depreciation, but remember it is a non-cash expense, and we're focused on the actual amount of cash expenditures we have to pay for overhead costs in preparing our manufacturing overhead budget. Okay? So the direct labor hours shown here for each month are coming from your direct labor budgets. The manufacturing overhead rate we're going to assign for overhead costs is $20 per direct labor hours. So we're going to assign $20 per direct labor hours to get your manufacturing overhead costs for each month. So you're multiplying the direct labor hours times your overhead rate to get your direct labor hour, to get your overhead costs variable for each month. So $26,000 in April, $46,000 in May, $29,000 in June is a total of your variable manufacturing overhead costs. We're going to add to that our fixed overhead cost, which was $50,000, and that gave us our total overhead cost per month for the quarter is $251,500. So total overhead cost for the quarter equals $251,500. Now remember that depreciation is a non-cash cost. So we're going to subtract that $20,000 from that amount each month to get the actual amount of cash disbursements needed for our manufacturing overhead costs. So again, we subtract out the $20,000 each month to get the amount of cash disbursement needed for our overhead costs each month. Now, we do have to show the total overhead costs each month, including those non-cash. And why do we do that? Because we want to figure out what's going to be our overhead costs per unit. We know the overhead rate variable. We know the fixed overhead cost, but we're saying what would be our overhead cost we're going to assign to each unit. So let's take a look. So our total overhead cost for the quarter is $251,000, and that's based upon a total of 5,050 direct labor hours. So that means that our overhead cost is going to be at a rate of $49.70 per hour. Again, our total overhead cost will be $49.70 per hour. That's going to be important a little later on, so keep that, write the number down, because as a little later we're going to do our production. We're going to look at our overall product cost, and we're going to assign overhead at a rate of $49.70 per hour. Okay? Next, we have what we call our finished goods inventory budget. Our finished goods inventory budget. Remember that it costs, or the quantity is 5 pounds is needed to make 1 unit. Our cost is 40 cents per pound. Again, we need 5 pounds to make 1 unit, and our cost is 40 cents per pound. So our material cost is going to be $2 per unit. It takes 0.05 hours to produce 1 unit. Again, it takes 0.05 hours to produce 1 unit, and our labor cost is $10 per hour. So direct labor cost per unit is going to be 50 cents. Now remember that the overhead cost was $49.70 per unit. Or I'm sorry, $49.70 per direct labor hour, and it takes 0.05 hours to produce 1 unit. So the overhead cost assigned to each unit will equal $2.49. So when you add these amounts all together, our production cost per unit is $4.99, meaning that it costs us approximately $5 or $4.99 to make each unit. Now remember that our ending inventory in units, this was shown on our production budget, was 5,000 units. So at the end of the quarter, we expect to have a total of 5,000 units. The product cost is $4.99 per unit. So our ending finished goods inventory has a total value of $24,950. So we expect to have a total of 5,000 units available at the end of the second quarter. Our product cost per unit is $4.99. Therefore, the total value of our ending finished goods inventory is $24,950. Okay? We're almost done. We got a few more budgets left. Next up, we'll look at our selling and our administrative expense budget. Our selling and administrative expense budget. Stay tuned.